This is InvestTalk. Independent thinking, shared success.
Hey, this is Thomas over in Santa Cruz. I'm calling about Eastman Chemical, ticker symbol EMN. I am a holder of this company. I'm using it as a portfolio diversifier. I was wondering where it is at the current price point, if it's continued to be a buy, or if with this current state of what's going on in the world, if there's anything that affects this name in particular. Like I said, I do have a position in it. I'm open to owning more of it and dollar costing down. I was wondering at what point would be smart to continue to do so, and if that is right now. Thank you so much.
All right, looking at Eastman Chemical. Let me just pull up some data here. And this is a name that certainly is a pretty good value based on earnings. So it's to earn $7.41 this year. Now that is down 6% from last year, but earnings are expected to bounce back to $8.32 next year, 4.3% dividend yield. But it's a slow grower, which means that, and it's more of a price taker. So it's always going to trade at a bit of a discount. A lot of people are going to look at that P/E ratio. It's earning roughly $8 per share. It's at $76 per share. That's a 9-10 multiple. That's low, right? A lot of people think that's low. But they do have some debt. It's a low growth business. They certainly can afford that dividend. So I think the dividend is certainly fine on that front. But it is near some good support longer term. So I do think it's a pretty good risk versus reward down here. I will say that. Doesn't mean that it's a slam dunk. That's for sure. There's certainly some economic risk. The economy is slowing to a degree. And you have to take that into consideration in any of the chemical names, and the chemical producers, and this is Eastman Chemical. So think of Eastman Kodak, and this is a large name, relatively $8.8 billion, mid cap, shall we say now. But like I said, it is at support. It is a good risk versus reward, but it's not without its risks. And in a slowing economy, when chemicals are used to produce physical goods and the economy slows, people tend to consume less physical goods. So that is one of the issues, but it is down from 110 recently last summer, and now it's down to about $75 per share. So a lot of that economic weakness and slower growth has been priced in. So I'm going to give this one overall a thumbs up because it's a good risk versus reward. And I think the dividend is sustainable and it's at support. So I'm going to give Eastman Kodak a thumbs up. Let's pivot over and take a question that came in via our YouTube channel comments. And I don't know how to say his username, but it says, I would love to know how much physical precious metals Justin owns. That would tell us his overall confidence in the current financial system. I do not. I own some gold jewelry, but I don't own bars of gold or coins or anything like that. I just don't think that is. I don't think that is I don't say people shouldn't do it. I just don't think that it is an efficient way to gain exposure to precious metals. Now, do I have a lot of precious metal exposures in my portfolio? Companies, miners? Yes, I do. But I don't own any physical precious metals beyond just your kind of, some necklaces and some, maybe a couple of rings and things like that. Not a material amount of gold. And I don't see myself doing that because, if you need physical gold, the world is crumbling around you and you probably need more important things than gold. Food, shelter, firearms, things like that. So I don't see the world devolving into that type of situation. And so that's why I don't have much physical gold. So yeah, hopefully that answered your question. But if you want to add some, if anybody wants to own physical gold, I don't frown upon it by any means. It's just not something not a decision that I've made personally.
Thank you for watching.
If this video was helpful, please give it a thumbs up and subscribe to catch our upcoming videos.
Hey, Luke and Justin. Bill from Philadelphia here. I'm calling regarding DOW Incorporated, ticker symbol DOW. It's got a very large dividend as of right now, but that's not really why I'm calling. I feel like it might be a good buy. It's at looks like around close to a 10-year low. I was wondering if you guys see this as a good entry point to pick some up. It's a chemical product producing plant that is very picks and shovels, deals with products for automobiles, appliances, plastic materials, all that such, and has about a $20 billion market cap. Seems like it could be a good flyer to take right now at this price point. I wanted to get your opinion. Hope all is well and love what you guys do in the show. Thank you.
All right, looking at Dow Chemical, and this is kind of similar to Eastman Chemical that someone called about earlier. However, it's doing far worse. In fact, this year, earnings are expected to fall 79% to 36 cents from $1.71 last year. And you talked about the dividend, 10%, but if you ever see a dividend of 10%, you should probably raise the red flag and say, why is it yielding 10%? And I think that's very simple in this case because it is not going to continue to pay that dividend. Okay. This dividend will be cut and frankly, probably eliminated very, very soon. Why? Because their free cash flow has turned negative. Negative 495 million trailing 12 months. It peaked out at 6.5 billion just in the second quarter of 2022. And last quarter alone, free cash flow was negative 594 million. This is worse than any month. Actually, at a 1 month. Actually, no, this is worse than that month. Yeah. It's the worst month in kind of the history of the series that I'm seeing. And the issue with going negative, this negative in free cash flow, is that they have a lot of debt. $15 billion in debt on a $19 billion market cap. When you have that level of leverage and your cash flow goes negative, that is a huge problem. And then if you look at times interest earned, it's only at 2.4. When it gets below 2, that's usually a very bad sign. And so you have an environment of rising interest rates. So refinancing this debt, have to look at their debt maturities. But what the market is signaling here is that this company not only is highly likely to cut their dividend or even eliminate their dividend, but it is increasingly likely that they will go bankrupt if this level of cash flow does not turn back to positive and significantly positive because of that level of debt. And if you look at its chart, it's not doing anything positive. It's below all the major moving averages. Every little rally gets sold off rather quickly. And it still is hovering near a 52-week low, right around $27. The all-time or the 52-week low would be around $25. So it's barely off of that level. And the trends of earnings expectations continue to go down as well. So you absolutely want to pass on this name. In fact, I think this is probably a pretty good short. Because that dividend, you don't have to pay that dividend for very long because it's probably going to be cut or eliminated. And there's a pretty good chance that this is a company ready for bankruptcy. Now let's play two in a row from 888-99 chart. And this came in earlier from a listener in Denmark.
Hello, InvestTalk. Question about ticker symbol BIIB, Biogen. As you mentioned earlier, the health sector seems attractive this year. I was looking at the fundamentals of Biogen. According to my analysis, they have a fine net margin. They have an excellent balance sheet. but the price of the stock is down at the 2012 level. Can you explain that? It seems like a good opportunity to buy, but maybe there was something I'm missing here. Why is it just keep going down, down, down? Should be a solid company. Thank you. This is Yannick from Denmark. Bye.
All right, looking at Biogen IDEC, BIIB, and this is a name that historically has had good profitability and been a good performer. No dividend, but earnings are pretty good, but they have been falling really since 2019. 2019 earnings were $33.57. And they declined all the way till 2023, went to $14.72. Now bounced back a little bit, up 12% last year to 16 and change. But this year expect to go down another 10% to $14.82. So no growth, really negative growth over the last 5, 6, 7 years. And going forward, the growth doesn't look very hot either. And if I look at its free cash flow, it's now down to $2.2 billion. From a high of about $6.25 billion just back in mid 2020. So that's the issue here is it's in a downtrend because, where is the floor? Where is the growth? Where is the beef here? Profitability is return equity 9%. And that peaked out at 46% back in 2020. Operating margins are down to 23%. And that peaked out in 2020 around 50%. So their margins are declining. There's obviously worries about their profit, their ability to keep prices high, raise prices, their pipeline, etc. So I just don't love the trends. I don't like the trends in the profitability. I don't like the trends in the stock. I think you're trying to bottom fish. And you may be right. The chart is getting a bit better, but it's not giving me really strong signal that it is going to actually create an uptrend anytime soon. So it's a name I'll probably keep on my watch list to monitor to see if it can create some relative strength on the chart, that cash flows can turn around, that earnings can turn around back to solid growth, etc. Because you're right, if you go back a couple decades, it was a strong grower. But those times are certainly behind it. And until they can reestablish their mojo, I'm staying on the sidelines with Biogen IDEC, BIIB. Now let's touch on the labor market. And right now you have a combination of a drop in immigration and simply a graying of America. So the flow of migrant workers into the U.S. is effectively halted over the past year. It was already at a slow pace going into the election, but it's ground to a complete halt recently. Now, that was part of President Trump's mandate to a degree. And you have the rise of deportations that also compounds that side of the labor equation. Then you have workers just getting older. And this is creating what is likely to be a labor crunch on the horizon, and it's coming up fairly rapidly. Economists at Barclays think that the trends in non-farm payroll growth could fall to less than 10,000 per month by the end of next year from more than 100,000 today. That's not far off, 18 months from now. Now, they estimate that that job growth will fall to about 60,000 within the next 6 months, so by year end. So the days of 100,000 plus jobs created each month are probably soon behind us. And it's going to slow the economic potential to about 1.5% per year from a little over 2% now. Because remember, job growth is really the engine to growth in the overall economy, right? If you don't have a job, you're probably not spending much. If you get a job, you probably are spending a lot more on going out to eat, buying things, traveling, getting a nicer apartment, buying a new couch, whatever that is. Now, the average monthly private payroll growth over the past 2 years has been 172,000. So that's what we're likely seeing here. This is coming from Barclays. From 172,000. Right now, we're around 100,000. By the end of this year, probably 60,000. And by the end of next year, closer to flat line, maybe 10,000. And they expect the effects of population aging to intensify very soon. Once again, this is just demographics. It's not anything policy-wise that you can do about it. Now, U.S. immigration on that side, that surged over the past few years. So a lot of this is a give back of net 3 to 4 million new, I don't want to say citizens, but new people in the United States that were taking up a lot of those jobs. Barclays estimates that about 3/4 of average monthly private jobs gained of almost 180,000 were filled by migrant workers over the past couple of years. So while, you could argue whether you want that many people in the United States and taking jobs, getting jobs, the bottom line is those people, for the most part, keeping their money here and they're spending it and they're living, and that's part of the economy. But now Barclays estimates that current deportations are running about 10,000 a month. Now, under Biden, the average annual deportations were around, let's see, what is this? Looking at a chart here. They were closer to 5,000 a month. So it's about double what it was before. Kind of the average of the 4 years under Biden. Trump was closer to, his first administration was closer to about 6,000 a month. And so going forward, the U.S. census projects that the population will decline by about 50,000 next year. 50,000 next year. And 100,000 in 2027. And that the aging of the population will cause the workforce to shrink by about 360,000 this year and next, and then accelerate thereafter. So it's a combination: net immigration and boomers simply getting older. And this is a headache for the Fed, because obviously a labor shortage will cause higher inflation, especially on the services side, which the services side of the economy is about 75% of the overall economy is on the services side. And you need people to do these jobs. And you're already seeing, if you look at the ISM prices paid index, that has accelerated to the upside. Whereas the employment index on that series is flat. New orders are in negative territory. It's a very stagflationary report, at least the last couple. And so that's a difficult environment for the Fed to handle. Creates extra level of uncertainty of beyond tariffs, right? That impact will likely hit this summer. And then going into the fall and into next year, you start to see the immigration and aging population part confound the inflation picture. And so this is something that is not being discussed enough, because it does a true impact on our economy. Now let's go with another YouTube question. Daniel says, what's the difference between a 403B and a regular 401k? Well, put simply, a 403B is typically in relation to some sort of nonprofit. Okay. Or some sort of 501c3 nonprofit, or some sort of public school, for example. So if you're a teacher, You probably have a 403B if you work for some sort of nonprofit, tax exempt organization. You also will have a 403B. But from church, right? You work for a church, for example, public college, university, high school, etc. And their rules are largely very similar to a 401k. They're just not run by a for-profit institution. And so very similar to, you do the same thing with a 401k as you do with a 403b. From an investment standpoint, there's usually a set of investment options. You can roll that into an IRA once you leave that job, and no tax consequences, etc. Some of them have Roth options, I believe, 403bs, but some of them don't as well. But for all intents and purposes, they're the same. It's just who's the employer.
Stay informed and stay empowered by visiting investtalk.com today.
Justin Luke, I was calling today about two financial companies, hoping to get some international exposure. One is a large cap, one is a small cap. You could take a look at Barclays, ticker BCS, and the second one is FinVolution Group, ticker FINV. They both have run up lately. Hoping you could take a look and see if they're still worth it at these valuations. Thank you very much. Love what you guys do. Have a good day.
All right, looking at two foreign financial companies, Barclays, which has been around for a long time. It's a $70 billion bank based out of the UK, and 2.3% dividend yield, and it is very strong. It bottoms around $6 back in the fall of 2023, and now it's at $18 per share, and relative strength is 92. So it's just crushing. It's doing very, very well. If you want exposure to a UK bank, Barclays is overall long-term a pretty good performer. And I'm a much bigger fan of the foreign banks right now than I am domestic banks. So I like that. I like that they are large, global, diversified, etc. Now, when it comes to FINV, that is FinVolution. FinVolution. This has not been around a long time, and it's out of China. Okay. And that is my biggest issue. The Chinese company, you can't always be sure that the data is correct. Now, if it is, it's certainly cheap, but is it cheap for a reason is the big question. If I look at, let me see this. Yeah, I mean, the relative strength is good. It's in an uptrend. Not as strong as Barclays, but certainly in an uptrend. And it's certainly cheap. Price to sales right around 1.4. Enterprise value to EBITDA around 3.2, which once again, that's very, very cheap. But is the market pricing it that way for a reason? And then that is your main question here. Do you want exposure to China, or do you want exposure to the UK and the European economy and really the global economy? Whereas FinVolution, it's in the consumer financing services business in China, which, that's going to be highly reliant on the Chinese economy. And then you have to trust also that these numbers are accurate and that you won't have some sort of rising tensions between the United States and China, for example, that this gets delisted or something like that. Right? So there's some geopolitical risks here that I don't love. And I much rather own a Barclays. Bigger, safer, certainly stronger, and I think has more upside. So if I'm going to pick one or the other, I'm definitely going with Barclays. Okay. Thanks for the call. Let's talk about the dollar. Speaking of foreign investments, dollar's having the worst performance since 1986. And it appears that foreign investors are gradually reducing their exposure to dollar assets. That who is selling? Well, it's pretty easy. Private investors in Europe have a lot of equities. And they're the ones mainly selling equities, reducing their exposure and buying into foreign equities. And so that's part of the reasons why you're seeing that outperformance of those foreign names. Now, on the bond market side, research is showing that the dollar's average daily decline in the last few months have really come during Asian trading hours, suggesting that those Asian holders of US bonds are the ones that are either increasing their dollar hedge or just outright selling their assets, selling their bonds, and moving them into a different currency. And so that's where these flows are coming from. It's not something they're dumping just willy-nilly. It's not like they're panicking out of the dollar, but they are certainly diversifying in a major way. And foreigners own $31 trillion of US securities, about 17.6 trillion in equities, 13.6 trillion of bonds, according to the BIS. It represents about 18% of the overall US equity market and about 21% of the total US agency and corporate bond market. So it's not minor. It's about a fifth of the holdings of US assets are held abroad. And if they continue to dump those assets, that will continue to put pressure on the dollar to the downside. And that's frankly what I continue to expect. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads. And you can find our podcast anytime at iTunes, Spotify, or Google Play. Be sure to rate and review on iTunes as well. And if today's show made you think about your own financial picture in any way, maybe your broader investment allocation, tax impact, retirement planning, all of that, well, I encourage you to reach out and set up a no-cost portfolio review with myself or Luke to help bring clarity and confidence to your situation and make it all work for you. So just head over to investtalk.com and click on the portfolio review button. Independent thinking, shared success. This is InvestTalk. Good night.